Hey guys, time for another market update. This will be a bit of a longer one as it's the first update of the month, and those are going to be a bit longer. I have the blog post over on Medium you can read. A lot of the same information, there'll be a few things different here. The back tests, I started out with some back tests. FANGMAN, so I use these tickers. It's not all FANGMAN, but they have some longer history, so I use those. These are all the instances of FANGMAN sideways, FANGMAN breaks out to new highs, and this eliminated the duplicate signals. That's why there's only 5. There was a lot more signals, but this is taking out duplicates. So how did that back test? And this is the times that happened on SPX. Here's the back test with all the samples included, and surprising to me, because one of the things I kept saying is, you know, FANG has been very constructive and sideways. That's one of the reasons it's hard for me to get too bearish. However, maybe that wasn't correct. So this is why we test things when we can. We can't test everything, obviously, but below average returns on every time frame, except for, well, even flat one day later, but who cares about one day later? Yeah, it was interesting to me. That is kind of the opposite of what I think, and you'd be surprised when you start backtesting things how often that actually plays out, where it's just the opposite of what you would think it would be. So let's look at SPX. This is SPX again. Both these backtests are SPX returns, not FANGMAN returns. I didn't test the FANGMAN returns, but if you look at the chart, I think they were probably better than SPX was. So interesting, yeah. 2 months later, not very bullish. Way below historical averages. Up to 1 year later, even 1 month to 1 year later. So this is not as bullish a factor as I thought it was for the S&P 500. So there was FANG, and there's these removed duplicates for the S&P 500, and it did trigger quite a few times right before some pretty major corrective periods, and some were just minor corrective periods. But almost every single time there was at least some turbulence. So that's interesting. That was the first back test. And then I looked at fund flows. We've had massive fund flows into US equity ETFs in the last 5 weeks. The 5-week moving average is by far the highest we've ever seen, so I back tested that. And here's all the signals of basically very high 5-day moving average. They had the signals in 2017, and that's why context matters on things. When you see it after a huge ramp up period like we saw early 2018, late 17, early 2018, it's just so much easier to trap a group of individuals after a huge ramp up than it is after a major consolidation. We trapped a lot of people down here bearishly, in bearish positions if you look at the flows. So a lot of those bears, maybe were capitulating as we broke out here. And so that's part of the flow. And then you have new longs entering, and so that you get very high flow there. But when you get it after quite a historic rally, in that case, and then, yeah, even to some extent here, seems a little different, and even now it definitely seems a little different than it does here. These 2017 signals throw off the back test a bit. So it is still actually slightly above average returns when you see this, but context matters. So to me, this is starting to be a bit of an issue when you see that kind of inflow. AAII, everybody's excited about this. And it's not my favorite thing in the world to look at AAII for several reasons. One, it's a survey, and I don't pay a lot of attention to survey stuff as much as like hard positioning data like COT, just because I don't think people are always 100% honest in surveys, and many other factors. And the other thing with AAII that I wonder about is how many people still are involved with AAII. How many are still, you have to be, it's a membership thing. How many people are still, how many people in their 20s to 30s are joining AAII, or however, I can't say it for some reason, but you see right here, it's AAII. It's AAII. Yeah. I mean, so in terms of backtesting, I don't just care about history, and this has plenty of history, but I also care about the broadness of the data. You know, if there's less people in AAII these days, then I think it's less of a factor, right? I mean, it's not as broad of a data set. I don't know if AAII membership has been declining or not, but my guess is it has, but who knows? I mean, I was wrong about the FANG thing, so definitely could be wrong about this. Anyways, all that aside, it's a fairly significantly below average backtest when you see this. But still, because we're talking about S&P 500, I mean, still bullish, but just below, these are just below average returns. I think the average return for S&P 500 for a year is like 6, 7, 8%, somewhere in there. So it's below average. So this becomes a headwind. I think you can add this to the pile of things that are starting to develop that are no longer in favor of the bulls. And AAII fought this uptrend for a long time. And in November, they said, okay, we're finally bullish. And backed off pretty hard. And it didn't take much. A little bit of weakness in February backed them off pretty heavily, but they're right back. So not a bullish factor anymore. I looked at this at the beginning of the videos and my blog post last month at the beginning of the month. Liquidity premium. And this has been a pretty accurate thing in terms of, I mean, it's worked pretty good in recent history. Can be a bit early, but I talked about this in that video last month. Basically what this is, the ratio of volume in QQQ versus underlying stocks. And when this gets high, people are rushing to the safety of QQQ because it's very liquid. And it's been pretty accurate at locating bottoms. Can be early, but you can go back several times. And there's false signals, just like with everything. And I haven't spent a lot of time backtesting this, but just on the surface, it looks pretty good. SPY liquidity premium didn't get nearly as high, but it's also starting to come down. Both of these are no longer like bullish headwinds as much as they once were. People are rushing out of safety and into risk again. I mean, not quite as extreme, but they're getting there. NYSE and NASDAQ short interest, NASDAQ near the highs. NYSE has had quite a plunge in late 2020, early 21. So with NASDAQ, you know, slowly trekking higher, but not real aggressively, and NYSE plunging, we're definitely losing shorts over time. But we had these pockets of high short interest on the QQQ ETF and all the FANGs that I showed you last month. Very slight drop so far, but this is starting to get a bit outdated. Let's wait till the next update and we'll see. I suspect you'll start to see this drop pretty hard. I mean, price action wise, we've seen a little bit of a melt up here that seems to be starting. And I think that a lot of it is forced buying at this point, a lot of short covering. And once we get these FANG and Q shorts out of the market, I don't know that you'll have many shorts left as a whole. And then that's when risk gets quite high. Dealers, COT dealers, very slight uptick this week. But this is from Tuesday, remember, it comes out Friday, but it's for Tuesday's futures close. You did have that big drop a few weeks ago. I suspect if I end up being correct that we're getting closer to a correction here again, you start to see these drop pretty hard. That would confirm that. You'll start to see the dealer positioning drop pretty aggressively. This is the legacy futures contract, COTBASE.com, the stock index complex. Commercials did drop quite a bit this week, so the asset managers are selling pretty heavily. Still far from really high levels, or really, sorry, low levels of short interest on commercials, but pretty good size one week drop there. And this is from Tuesday, roughly right here. A lot happened since then. So yeah, I suspect this is probably, you know, somewhere down here at this point and dropping rapidly. This is a big thing I've been talking about and watching, the open interest ratio puts to calls on index options from the OCC.com. A lot of people look at the volumes, and that's fine, and sometimes I look at them too, but this is what's actually being held longer term, and you're finally starting to see a bit of a drop off here, and we are getting close to OPEX, and you do see these drops right before OPEX pretty often. But we'll see how big the spike is coming up after OPEX. If it's very minimal and then we roll back over, that would be a sign that institutions are finally reducing the amount of hedges that they're holding on to. And that would start to be, to me, quite bearish, because you have retail pretty exuberant still. And I think all we need is institutions to stop fighting the market as much as they have been with aggressive hedging and even some outright shorts, I think, that still exist. You get them out of that picture and probabilities shift dramatically. FANGDIX, pretty solid. Not much to say here. This is part of the reason DIX as a whole is improved so much, because FANGDIX improved a lot. And FANG's still pretty strong. And yes, it probably, you know, I'm sure it probably does make new highs before we have issues, but we'll see. Semiconductors, a lot of people excited about them. And risk reward back in here was pretty decent. We're starting to lose that same risk reward profile. The purple line is 5-day moving average of on the SMH ETF itself. Big plummet this week. Last time you saw that was a top. The blue line is 5-day moving average of the top 10 components of SMH. Starting to decline here after some aggressive buying down at the lows. A little bit of a ramp at the end of last week, but overall, dark pools are showing less interest in semiconductors. DIX is still quite healthy, 44.3 on Friday, largely, like I said, because FANG is printing good dark pool numbers. So yeah, there's still plenty of things aligned in favor of bulls short term, but I do think the speed of this rally is starting to look like a melt up to some extent. We'll get into that more. Yeah, there's a lot that, I mean, DIX can change pretty fast. We did a 47.3 on 6th of August. We have this melt up, and by the end of August, in 3 weeks later, we're printing very low DIX numbers. I think this may be something we potentially see here very soon on that. People get excited about the GEX number being record. This isn't the correct GEX number. This isn't the actual gamma exposure. Yeah, if you don't know why, I guess leave a comment in the YouTube comments, and somebody will explain it to you. But it's not the true GEX positioning. GEX is definitely increasing, but it's not that high. Total DIX is 47th percentile on the moving average, so still below average dark pools on all stocks. So at this point, we have FANG dark pools really carrying the load, if you will, of dark pool buying. And remember, Squeezemetrics DIX is kind of a market cap weighted index, so your big FANG affects the entire index quite a bit. BofA bull bear, still 7.2, a bit high, not extreme high yet, but I think this will start to ramp pretty hard now. Insiders were buying pretty aggressively in March and are now back to neutral. Same story on the seasonally adjusted. Hedge fund exposure, like I've said, we need to get this up above the red line for a while, and that'll be another sign that institutions are cutting back on hedges and getting more net long. Getting there, certainly getting there. Definitely room for upside on that. ETF assets, leverage long, just wow, I guess would be what I would say about this in the last few weeks. And you look at the entire history, it's pure insanity. But then you have a huge ramp here on top of that the last few weeks. It's crazy. People love QQQ, apparently. And the leverage shorts have plummeted. They're back to, they've made it back to early 2020 levels. This is, you know, it's another, I mean, leverage ETFs are only a certain part of the market. It's not the entire market by any means, but you have to factor this in as something that is no longer, it's definitely not bullish at this point. Investor Movement Index from TD Ameritrade, probably my favorite retail metric out there. And retail is about as euphoric as they can get. January 18, we're close to that. The difference between now and January 18 is institutions were also euphoric. And to me, they're still not euphoric. Some of them are a bit bullish, some of them are not. I forgot to put that chart in here of the institutional positioning, but maybe I'll post it on Twitter or something, where the risk parity and the CTAs were still not long, where most other strategies were, and that was because of VIX. And remember, at the first video I talked about VIX needs to normalize to get risk parity and CTAs long. Well, VIX is normalizing now for sure, and so I do believe part of the reason you're seeing such a ramp is because CTAs and risk parity strategies are getting long now finally. Combine that with some hedges being removed slowly, you saw that earlier, that's why we're melting up, and then that sets us up for actual corrective periods where we can actually reset some sentiment. Social sentiment, this is sentiment traders for the Qs. Basically under the red line, people are too bullish. Well, they've been that way for basically forever, according to this one. And this is what I don't like about these social sentiment things. I've looked at a lot of them. They all tell you a different thing. Here's another one that I've seen this week. Completely the opposite of that previous one. Which one is right? They're showing quite heavily fearful people on Twitter on this one. The reason I kind of thought this was interesting is because it just seemed like on Twitter there was quite a bit of fear recently to me. So maybe this one potentially is a bit more accurate. I'll be watching this one for a while just to see. I guess currently it's at 59.24. I don't see that here. Not seeing where that's... Yeah, 59.24 would be up here somewhere. So anyways, maybe this currently isn't as fearful as it's saying on the chart, which would make sense. I don't see how people are still this fearful. That doesn't seem possible with the rally we've had. NASDAQ. A little bit more fearful than NASDAQ, which makes sense. Russell seems to be the same. Okay. Like I said, we may be entering this melt up similar to late August, and if so, 42.20 by the 14th of April, just next week. It's possible. And if you see that, I think you would see the market move way ahead of options open interest levels. And when you see that, this came from Spot Gamma. He mentioned this one time. When you see the market ramp heavily and the options, the SPX options, open interest levels can't keep up, then you see a very unstable market condition, and that's where you get pretty sharp corrections. This was almost, to some extent, kind of a little bit of a crash here after we had that huge run up. Yeah, I do think if we get to 42.20 by next week, and especially if we break above there, I will be selling pretty heavily, and it might even be possible that I take some shorts, and I don't do that very often. It's extremely rare. I'm almost always some degree of long the indexes. I just vary my levels of long exposure, like I've said many times. But yeah, we see that, and I see some other things like very low DIX and things like that. Yeah, I'll be probably full cash at that point. 5-day SPX VVIX correlations. This is something that I do like as a potential caution indicator. Combine it with some other things. It has worked quite well recently. This one was a bit of a false signal, but we had come out of a pretty good little corrective period there, so that is understandable. Worked good here. And I've backtested this as well, especially when you combine it with other factors. It's something to think about for sure. VVIX and SPX 5-day correlations, not VIX, volatility of VIX. Definitely starting to creep up pretty heavily on the 5-day correlation. Something to definitely keep on your radar. IMO. Just threw up some comparisons. 2010 in green. So if we do a 2010 type of pullback, again, price action has mirrored 2009 pretty closely. So now we could be like 2021 could be similar to a 2010 type of period. If so, that was a 17% correction, which would take us all the way back to 3,400, which would probably shock a lot of people, but it's within the realm of possibility here. Do not discount it as possible. 2019 would be the blue period. We pulled back roughly into this area. That would be roughly 3,800. 2015, 16, we did a lot of sideways. We could pull back as low as 3,650 on the first retracement in that scenario. All these things I think are becoming a relatively high possibility here. I've been asked about Palantir and Snow and some of these other mega momentum names from last year. Just read my blog post about it, but dark pools are not buying them. Order flow is not healthy on them. You know, valuations are not healthy. The story got way ahead of itself on these, and 2020 was a very easy year. People were just throwing out tickers and everybody would buy them and stuff would go up, and now a lot of people are trapped. And that's why I get PMs about like these kind of top stocks. Like, what do I do with this position that I bought at 38? If that was a trade, then you're not trading correctly. You don't know how to trade. I mean, I don't want to be mean, but if you bought this as 38 as a long trade and you're still holding it, that's not trade. If you bought it as an investment, well, even as an investor, you need to try to think about risk reward when you're buying things. But if you did buy as an investment and you're thinking 5-10 years from now, well, this pullback shouldn't be bothering you because you shouldn't have gone all in on it, and it's only a part of your portfolio. You should be fine. But if you want all in with leverage on this, I mean, I can't help you. It's one of those lessons that a lot of us learn at some point, unfortunately. There's just no nice way to say it. I don't like to be mean to people, but there's no nice way to put that. I mean, unfortunately, somebody's got to tell you, hey, man, you got to figure out a way out of that situation pretty quickly, and you got to start learning methods to actually trade and risk management. You got to have a plan before you buy stuff. And so that's part of the reason I think we may need to digest some more, because we have so many people trapped in things like this. And who knows? I mean, the market could really melt up, and this could get back to the highs and maybe bail some of these people out. It's possible. It's been a crazy market, but I do think that kind of crazy trading, like easy trading, might be kind of winding down. Not that we won't be able to make bullish trades. We still will be for sure, but especially after we reset some sentiment. I threw this in here. I don't think this was in the blog post, but I threw this in here real quick. Valuations. The last 2 times we had pretty major spikes in SP 500 valuations. We're kind of close to major lows on SP 500. And context, right? Context matters. Now we're getting a pretty big spike in valuations, but we're way extended from any kind of low. I know it's simple, and maybe people will laugh at me for looking at it like this, but I think it's a bigger factor, right, when it's happening and price is a bit extended at this point. Now, when the economy reopens, it should help valuations out as companies start earning more revenue again. And then also, I think there's a chance for price to pull back a bit, which would also help valuations, and some sideways would help. But this is a factor as well to consider. People are not talking about valuations as much now. Remember what I was talking about earlier? They were talking about it a lot, and now they're starting to not talk about it. So now let's talk about it. Seasonality. I drew this on there on the blog. Can be a lot of sideways and chop starting very early in May here. So that's another factor to consider. I remember in last month's video was early April when I did that, and I said, this is bullish, seasonality coming up, and it did play out. Doesn't always play out, but it played out. So the probabilities, read through this. I still think we can continue higher. I mean, you still have good DIX, COT. Still have enough things that are still okay. But I think, you know, my probabilities are starting to drift to a little bit more bearish here. So consider that a factor when you're talking to somebody that's not bearish that often. That is a factor. I think that's it. Yeah. Oh, I was gonna say, what else do I have here? Oh, the thought of the week. I didn't put anything in there, but the thought of the week was going to be, it was going to be about style drift. Style drift. What do I mean by that? It's a lot of people will like come up with a method, and they'll slowly drift to another method and another method and another method, and they never stick with a method. And to some extent that's fine early on until you find something you kind of like, but eventually you got to get into some kind of method that works for you, and also not just works for you. People say that all the time. Well, it's got to work for you. Well, some methods just don't work. I don't care who does it. So it's got to be a method that actually works, but then yes, it has to work for you as well. And then you got to stick to that method and improve it. Every single day look to improve it, but you're not like drifting way away from the original premise behind the method, right? The other thing to add to that is there's a lot of people out there that are in love with their method, and they will go so far as to look at other people's method and say, that don't work. The only method that works is mine. Your method doesn't work. You see that a lot. I see that a lot where people are like, why are you trade like that? Why don't you trade the way I trade? The way I trade is better. I don't know. I think there's quite a few methods that do work out there. There's a lot that doesn't work out there. There's a lot of things that don't work out there. I mean, people like, you know, you got your chart here, you got support resistance, you know, you break, you know, we're not touching this thing till it breaks above this line. We're not, you know, you could have bought down here. Yeah, you could have bought anywhere down here, but we're not touching it till it gets above here. That's their thing. Well, yeah, that's fine. There's nothing wrong with saying I'm going to be a breakout trader. Here's the thing. If you're going to be a breakout trader, you have to accept that your win rate will be very low. It just will be. Just start backtesting breakouts. I'll just backtest them and then come back to me and tell me, like, yeah, you were right. Breakouts fail a lot. Yeah, a lot of breakouts fail on stocks at the stock level. And it's fine. You can still buy them, but you got to accept that you need to exit when it, you know, it comes back under here. So you bought here, you know, you got your stop here. Let me put that red. You got to accept, hey, I need to exit here, right? And it's going to come back to here more times than you think, probably way more than half the time. But especially like when you're trading some of the high momentum type stuff out there, the ones that don't fail can go up. And you know, here's the moon or whatever. It's up here. It's made of Swiss cheese. So the winners can be quite big when you buy breakouts, but you can have a lot of losers. So there's nothing wrong with being a breakout trader. But if you're a pullback trader, you can have a higher win rate, but you're going to buy a lot of pullbacks that are just duds that just don't go anywhere. And then there's pluses and minuses to everything. A lot of things that really don't work. You know, head and shoulders patterns, a lot of these weird patterns, I don't think they really work. Yeah, I don't know what to say about that, but yeah, your system isn't necessarily the greatest ever, but you can make it really good if you constantly improve upon it. One final thing was I did start a Twitch channel and I'm streaming some chess. Come check it out. The URL's up here if you want to see me be very bad at chess, because I am just not very good. But you can come make fun of me and maybe play me in chess. I'm going to have a Discord set up where if you want to come in, we can chat about the markets. We can chat about whatever you want to chat about. Come on in there. We'll do that. Be a good time. I think that's it. I think I'll do a video next week, but it'll be much shorter. Yeah. Have a good weekend, everybody.